Hi there, a lot of talk lately about silver doing almost nothing while the world around it feels like it's getting louder by the day. So in this video, we're going to separate the signal from the noise, and you are going to walk away feeling a lot smarter about what a sideways silver market may actually be telling you. Because on the surface, it looks strange. You have tension in the Middle East. You have oil worries. You have consumers feeling squeezed. You have the central bank stuck between inflation and weakness. And yet silver is not acting like a rocket. It's drifting, it's pausing, it's frustrating people. Today is Wednesday, May 6th, New York time, and before we go any further, comment what day and date you're watching from. I want to know when you're seeing this, because sometimes the comments become a better temperature check than the chart itself. And if you value this kind of content, support the channel by subscribing and commenting John A.G. Best below. That tells me you want more straight, useful breakdowns without the noise. Okay? So let's start with the big question. If the backdrop is so serious, why is silver still moving sideways? Well, the first answer is simple. Markets don't always move when the headline hits. Sometimes they wait, sometimes they doubt, sometimes they focus on the stock market, sometimes they focus on rate expectations, sometimes they just need more pain before they reprice the risk. That does not mean the risk is fake. It means the crowd has not fully adjusted yet. And this is where silver gets interesting, because a quiet price can hide a tightening structure. Based on recently published numbers, global mine supply was a little over 800 million ounces last year, while total demand was a little above 1 billion ounces. Industrial demand stayed strong, recycling improved, but the market still needed existing stocks to help balance the equation. Now, that matters because silver is not just a shiny coin story. It is not only bars, rounds, and people stacking in their basement. Silver is also electronics, it is solar, it is vehicles, it is grid equipment. It is the kind of metal that disappears into modern life in tiny pieces. And that creates a problem. If silver is sitting in a vault, it can come back to market quickly. If silver is spread through millions of devices, panels, switches, and components, it is technically there. But practically speaking, it is not sitting on a dealer shelf waiting for you. So when people ask, is there enough silver? My answer is, enough for what? Enough for normal demand? Maybe. Enough for industry, investment, panic buying, monetary fear, and a sudden rush from people who waited too long? That's a very different question. And this is where I want to slow down, because the silver story is often told too dramatically. People will say, there is no silver left, and that's not really the right way to say it. There is always silver somewhere. At the right price, somebody sells. The issue is not existence. The issue is availability at current prices. That distinction matters. A shortage does not always mean empty shelves forever. Sometimes it means the market has to raise the price high enough to pull metal out of strong hands. It has to bribe people to let go. That is called repricing. And honestly, that is what I think investors should be watching for. Now, let's bring in the consumer side. According to the latest final reading, consumer sentiment in April was sitting around 50, down from the prior month and close to the kind of weak mood we saw near the painful inflation period a few years ago. The survey also noted broad weakness across groups and only a modest recovery after energy pressure eased slightly. That matters because the consumer is the emotional engine of the economy. People can still spend while feeling terrible. We have seen that before. But when confidence keeps grinding lower, people start changing behavior. They delay purchases, they question risk, they look at groceries, rent, insurance, fuel, credit cards, and mortgage costs, and they say, wait a minute, this does not feel like everything is fine. And that is the gap. The stock market can be high while household confidence is low. Both can be true. In fact, that combination is dangerous because it creates a market that looks strong from the outside but feels fragile underneath. So when somebody says, well, the indexes are near records, therefore the economy is healthy, I would be careful. Stocks can rise because earnings are strong. They can also rise because liquidity is expected, because a handful of large companies dominate the index, or because investors believe the central bank will eventually protect markets again. That is not the same as ordinary people feeling secure. And when people stop feeling secure, they start looking for things that do not depend on somebody else's promise. That is where gold and silver come back into the conversation. Now, does that mean everyone should panic buy metals tomorrow morning? No, that is not the point. Preparation and panic are opposites. Preparation is calm. Panic is expensive. Preparation happens when premiums are reasonable and nobody is yelling at you. Panic happens when everyone suddenly wants the same coin at the same time. So if you're successful, share your success story in the comments so others can stay motivated. Because a lot of people watching this are not trying to gamble. They are trying to protect years of work from a system that keeps getting harder to understand. And this is where the date becomes important. The next sentiment update is scheduled for Friday, May 8th, and I'm not saying that date is some magic crash button. Please don't hear it that way. What I'm saying is that when a market is already nervous, The next clean reading on consumer mood can become a checkpoint. It tells us whether the pressure is stabilizing or whether the public is getting even more defensive. That matters for silver because defensive consumers change flows. They may sell jewelry if they need cash. They may buy coins if they fear banks. They may cut spending if fuel rises. They may hold cash if headlines get worse. So the same weak sentiment number can push the market in different directions depending on what people do next. This is why I don't like one-sentence predictions. Silver is not a light switch. It is a pressure gauge. If pressure builds in energy, confidence, policy, and physical supply at the same time, then the move can look sudden even though the conditions were building for months. And by the way, gold is part of this too. Gold usually moves first when the market wants monetary safety. Silver often moves later, and when it moves, it can move with more violence because the market is smaller and more emotional. That is not guaranteed. It is just a pattern we have seen in past cycles. Gold starts the conversation. Silver turns it into an argument. So if gold holds firm while silver frustrates people, I would not automatically call that bearish. I would ask whether silver is lagging or whether it is quietly waiting for investment demand to wake up. Now let's talk about oil, because oil is the bridge between geopolitics and inflation. The Strait of Hormuz is not just a line on a map. The latest energy data shows roughly 1/5 of global petroleum liquids consumption move through that region, and the same route represented more than a quarter of seaborne oil trade. The same analysis also notes that alternatives are limited if that route gets blocked. So when the Middle East gets unstable, this is not only a military story. It becomes a shipping story. It becomes a fuel story. It becomes a food story. It becomes a mining story. It becomes a consumer story. Oil hides inside almost everything. It is inside trucking. It is inside fertilizer. It is inside shipping. It is inside mine equipment. It is inside the cost of moving heavy metal from one place to another. So if energy gets more expensive, the cost of producing silver can rise even if silver itself has not moved yet. And that matters because silver supply is not very flexible. A lot of silver comes as a byproduct of other mining. That means a silver price spike does not automatically create a flood of new silver. If a mine is mainly built around copper, lead, zinc, or gold economics, it does not suddenly become a pure silver machine because investors on the internet got excited. So silver supply can be slow, not impossible. Slow. And slow supply plus sudden demand is where the market can get uncomfortable. Now the central bank piece makes this more complicated. In its latest statement, the Federal Reserve held rates in the mid-3% range, said inflation was still elevated partly because of energy prices, and pointed directly to Middle East uncertainty as a risk to the outlook. That is important because it tells you the central bank is boxed in. If inflation rises because energy rises, cutting rates becomes harder. But if the economy weakens, holding rates too high becomes harder too. So the market is basically asking which pain gets worse first, inflation pain or growth pain. And silver can react differently depending on which one dominates. If the economy weakens hard, industrial demand can soften. That is the counterpoint. A slowdown is not automatically bullish for every part of silver demand. If factories reduce orders, if consumers buy fewer electronics, if financing slows solar projects, some demand can cool. But here is the other side. Long-term electrification, grid upgrades, defense demand, automation, artificial intelligence infrastructure, and solar deployment are not small one-week trends. They are multi-year themes, and silver's physical properties are exactly why it keeps showing up in those applications. USGS notes silver has exceptional electrical and thermal conductivity and many industrial uses, which is the real reason industry keeps coming back to it. So silver is caught between cyclical fear and structural demand. That is why it can be frustrating. It is not always clean. But sometimes the messy setup is where the opportunity lives. Now, on geopolitics, I want to be careful. A lot of people jump from one headline to total collapse in about 5 seconds. That makes for exciting content, but it can also make investors sloppy. The better way to think about it is this. Energy corridors create leverage. Whoever can threaten them, defend them, insure them, reroute around them, or price them has influence. That is why the Middle East keeps mattering. It is not just about one missile or one statement. It is about shipping lanes. It is about oil settlement. It is about alliances. It is about whether large powers can keep the energy system predictable. And when predictability breaks, markets do not just calmly update a spreadsheet. They reprice fear. But here is the part most people miss. You cannot control that. You cannot control oil lanes. You cannot control central bank language. You cannot control whether a ceasefire holds. You cannot control whether traders wake up tomorrow and suddenly care about silver. You can control your own fragility. That is the practical lesson. Do you have cash for near-term needs? Do you have debt under control? Do you have some hard assets outside the financial system? Do you have food basics? Do you have relationships? Do Do you have a plan if prices jump or shelves get thin for a while? That is not fear. That is being an adult. And yes, precious metals can be part of that plan. Not the whole plan. Not a fantasy where one coin solves every problem, but part of a layered approach. Cash gives you flexibility. Productive assets give you growth. Gold gives you monetary insurance. Silver gives you a mix of monetary insurance and industrial leverage. And that mix is exactly why silver can sit quietly for a while and then move violently when people finally connect the dots. One more thing. The strongest silver plans are boring on purpose. They don't require you to predict the exact headline. They don't require you to know which official says what next. They simply ask, am I prepared if paper confidence weakens, and am I still okay if the move takes longer than I wanted? That is the balance. Because if you buy only out of fear, you will probably sell out of fear too. But if you buy because you understand the role silver plays, then a slow week does not shake you. A dip does not humiliate you. A quiet month does not make you forget the bigger setup. And that is what separates a plan from a reaction. So how should we think about the current sideways movement? In my opinion, it is not proof that the thesis is dead. It is a test. It tests whether you understand why you own it. It tests whether you can accumulate without needing excitement every day. It tests whether you can separate a boring chart from a weakening system. Because when everyone is excited, the easy entry is usually gone. The better moments often feel dull. They feel annoying. They feel like nothing is happening. And then later, people look back and say, why didn't I act when it was quiet? Now, I'm not telling you silver has to explode tomorrow. I'm not telling you to chase. I'm not telling you to bet your rent money on a metal. What I'm saying is that the background is not calm just because the price is calm. Consumer mood is weak. Energy risk is real. The central bank is constrained. Industrial silver demand has a long-term engine. Mine supply cannot instantly respond. And physical availability can change faster than a chart prepares you for. And if this sounds too simple, good. The best protection usually is simple. It is not about predicting every headline. It is about reducing the number of ways one bad week can hurt you. That is why metals matter. Not because they make you fearless, but because they give you options when confidence gets thin. And in stressed markets, options are worth far more than empty comfort. That combination deserves respect. So don't confuse sideways with safe. Don't confuse delay with denial. And don't wait for the crowd to give you permission to think. Use the quiet time wisely. Build a plan before the market forces one on you. And remember, this is for education and perspective only. I'm not your financial advisor, and this is not personal financial advice. I'm sharing how I'm thinking through risk, silver, gold, energy, and markets, so you can do your own homework and make choices that actually fit your life.